Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hi guys, this is Justin. In this episode of Excess Returns, Jack and I talk with blogger and financial professional Joe Wiggins, who I would consider one of the leading voices on investor behavior. Joe's blog, behaviouralinvestment.com, is a must-read for investors looking to understand how behaviors, biases, and emotions can impact our investing decisions. We talk to Joe about a wide range of topics, including how to make sound investment decisions, the importance of focusing on process, and why a long-term view on investing is so important, and much, much more. Thank you for listening. Please enjoy this discussion with Joe Wiggins. Joe, thank you for joining us today.
It's a pleasure.
The topic of behavioral finance has become, I think, much more popular over the past decade as investors and people like us try to understand how emotions, biases, and habits influence us. But oftentimes I feel like the behavioral focus of it is like secondary. It's almost like a second topic in the overall discussion. But one of the things that I really value about the articles that you write and your blog, which is behaviouralinvestment.com, is that you have mostly, you started with this idea of writing about this topic of behavioral finance, and you've really stayed, I think, disciplined and dedicated to that. So on your blog, you said, you wrote this 4 years ago, by the way, you said the purpose of this blog is to take the insights gleaned from behavioral research encompassing areas such as psychology, sociology, economics, and cognitive science to better understand our behavior and its drivers. And anyways, just to start out, since I read a lot of what you write and try to almost read everything that you write, I think you've done a fantastic job of staying focused on that initial mission that you...
Thanks very much. I think it's very easy to, particularly in finance, which is such an investment, which is such a broad topic, it's easy to opine on lots of different things and have expertise in lots of different things. So I really wanted to focus on behaviour because I just think it's the most important thing that investors can consider and think about, and how we behave and the choices we make will define our long-term outcomes much more than what the next print of GDP will be. So we tend to focus and worry about the wrong things. So I wanted to focus on behaviour because I think it, in essence, it's an untapped resource for investors that can have a massive impact on our long-run outcomes.
Yeah, no, I totally agree. When it comes to investing, I wanted to start by asking you, like, how, from your perspective, how big of a problem is our behavior, and how would you go about trying to quantify that problem if you could?
Yeah, really difficult to quantify. I say it's the most important thing, but I don't have a metric to back that up. So I think our behaviour really is how we react to stimulus. And if you think about financial markets and the investment industry, it's just a torrent of stimulus, whether it's financial news, whether it's a different narrative or it's a different theme, whether it's market moves on any given day, whether it's the latest macroeconomic development. We're getting a constant stream of stimulus to affect our behaviour, to want us to change our mind or to make decisions. So it's this perpetual problem that we face in having to manage our behaviour. Investment is not just a start point and an end point, it's the bit in between that really matters, and what we do in between. So more than anything else, it's a thing that will define our outcomes, and it's a thing that we can get wrong on any given day. And if you think about one behavioural mistake you might make, so let's say you're investing for 30 years, and after investing in equities, diversified equity portfolio over 30 years for your pension, and 5 years in there's a bear market because of panic and stress, you sell out and then you buy back in when markets have recovered. So you've got the cost of that mistake from point to point, and then you compound that cost over the rest of the years to have a huge gulf in your potential investment outcome, a huge gap in your investment outcome because of that one mistake that you've made, which will outweigh any other decision that you make or any other choice that you might make between different funds or different markets. So even small behavioural mistakes can compound into very significant detriment to your investment outcomes.
So you made a good point there. Like, on the one hand, I think we probably understand more about investor behavior and what influence investor behavior, and there's more research on that and how the intersection of investing decisions and finance. But on the other hand, we're getting bombarded. There's more information, there's more blogs. You have obviously all the media networks, and so. I mean, do you think, is there any evidence to show that investors are becoming better behaved as we learn more about these behavioral shortcomings, or is that being counteracted by all that stuff I just mentioned?
Yeah, I'm almost certain it's worse. So I think you have this overarching issue where we're aware of behavioural weaknesses and behavioural biases, but we think they apply to other people, not ourselves. So we always find it difficult to be introspective about our behavioural limitations. But more than that, I think there's two issues. One is, as you've mentioned already, is technology. So good technology equals bad behaviour, I think, in investment, because you have a toxic combination of more information, so you have more stimulus, but you also have more ability to trade, so more ability to do stuff as well. So your ability to react to things is much greater than it has been before, and the stimulus that makes you want to act is much greater than it has been before. So the number of behavioural mistakes we're likely to make is probably increased significantly through time because of technology. And the problem is that technology and transparency and control are fantastic things optically for investors, but I think behaviourally they're a disaster unless you can find ways to control that. And I think the other point is, my experience is that time horizons are becoming shorter and shorter. So the myopia in investment decision making is pronounced, and people talk about months and about quarters and about single years like they're anything other than random noise. And that's everyone involved in investment, from individual clients all the way up to the regulator who obsesses about short-term performance. And that just encourages people into bad behaviour, so performance chasing and mutual funds being an obvious example of that. So I think improved technology, ever shorter time horizons means that behaviourally we're probably at our weakest point we've been in kind of modern investing history.
This question probably could have been our very last question. It might be the most important question, but these are all important. But if you were to try to highlight the three things an investor could do to try to reduce the role of biases in their decision-making process, what would those be in your opinion?
Yeah, good question. So the first one would be a simple checklist of our main behavioural limitations. So we know things like myopia, like overconfidence, like outcome bias affect the decisions we make quite profoundly. And a checklist before we make a decision where we work through that and try and understand where we might be affected is useful. It's not a fail-safe or a panacea, but it's useful to make us aware and put it front of centre rather than something that kind of lurks in the back of our mind when we're making a decision. So making a checklist of our behavioural limitations, a key part of our process, is useful. Second part, which I think is critical, is a decision log. So whenever we make an investment decision, we need to write down what we're thinking at the time we make the decision and also what we're feeling at the time we're making a decision. And then you can go through time and build up an understanding of your own behaviour and reflect on when you've made mistakes and what the most common mistakes that you make are. And if we don't do a decision log, we end up looking back, and with the benefit of hindsight bias, we rewrite history about the decisions we made in the past. So that discipline of a decision log is very simple, but also I think incredibly effective. And finally, I think adding friction to your investment process is important. So what I mean by that is, how do you slow down your investment decision making? So for a private investor, it might be something as simple as setting a password for your brokerage account that's difficult to remember or that you have to ask someone else to get. So it might take you a day longer, so you don't make decisions in the moment. For a professional investor, it might be using another person to ratify a decision or using a kind of dreaded committee just as a second step, just to avoid you making those in-the-moment behavioural mistakes. And obviously, for long-term investors, waiting a day or a week to make an investment decision doesn't really matter. So adding some friction back into the process, into what is now, I suppose, a seamless world in terms of investment decision making is really important.
One of the challenges I've always had in building, we build active portfolios for investors. And so behavior is obviously a big issue in that, because people, when you are active and you're different than the market, behavior tends to be a really important thing in determining whether someone will stick with the portfolio. And one of the challenges I've always had is trying to figure out in advance what someone's tolerance is, when their behavior will kick in and they'll abandon their investment plan. And I'm wondering if you have any tips in terms of how to look at someone's risk tolerance or their behavior in advance before you put them in a specific strategy.
Yeah, setting expectations, I think, is absolutely critical. So, irrespective of what's happened in the past with an investment, you need to set the correct expectations about what is reasonable and what's possible, and also making that very salient. And I guess the main concerns people have about their investment is underperformance or pronounced volatility on the downside. So being very clear and very salient about what that means and what it might look like to investors at the outset, I think, is very important. You don't want people being surprised. I think one of the mistakes people make is that they'll invest in a flavour of the month active fund that's got a fantastic track record and very consistent performance, and then they'll invest in it without an awareness that it's not realistic for that to continue into the future. And then when it goes through a difficult period, a barren spell for a year or two or maybe more, then they sell out because they didn't anticipate it. So I think you need to set expectations correctly and make it salient, maybe put it in dollars and cents in terms of the losses or temporary losses you might expect for any given period, but being very clear about the uncertainty and the potential range of outcomes through time at the starting point is really important. Obviously it doesn't replicate how you actually feel when you're going through it, but at least if you start by thinking about potential worst case scenarios, then that helps people think, actually, when I invested in this fund or this stock, this was one of the things I thought about, so it's not a surprise to me.
Yeah, we found that too. And, a lot of managers tend to try to sweep that stuff under the rug and say, here's our long-term performance and not talk about sort of the ride that it took to get there. But the reality we found is, if you want to get quality investors to invest with you, they need to understand what might and what might not happen. So in a lot of ways, it's better from a marketing perspective to be upfront about it than it is to maybe just say, here's this great performance, and not talk about the way you got there.
Yeah, I think you might get fewer investors, you get more long-term investors and the right type of investors for your funds if you do it that way.
I wanted to ask you, you've written a lot about fund selection and how investors select funds. And, investors, obviously, we've talked about performance, and investors tend to just chase performance. They tend to look for the best performing funds and try to, jump on them when they're already maybe at their highs. And I'm wondering if you have any tips in terms of how investors can maybe think more about process and maybe less about performance when they're selecting funds.
Yeah, I've a few bugbears about this. One of the main things is just the pervasive use of performance screens to filter fund universes, which I don't think I've ever seen anyone involved in professional fund investing not use. So this is where you have a search for a certain fund in a particular universe and you filter the universe by running a performance screen. So you say, how have these funds done over the last 3 years, over the last 5 years? You might include some risk metrics in there as well. And you, in essence, say, well, these are the top 10 funds over this time period. So this is the short list of funds that I'll look at. So in essence, you're building outcome bias into the process from your first step. So your short list of funds is just driven by outcome bias and the idea that there's a direct link between process and outcome rather than just randomness or good luck or certain styles or factors that have been working. So those performance screens are a massive problem because you just filter the universe by what's worked yesterday, and then you pay the price because you probably wear the mean reversion when you invest in the fund that's done extraordinarily well before you bought it. So those performance screens, I think, are a major problem and they shouldn't be used, but everyone uses them because I don't think they know how else to filter the universe. The other thing I think is an issue for fund selectors is they're very vague about skill and about what the edge is, and a skill to me is linking a process and outcome in a consistent fashion. But lots of fund managers just talk about their skill or their edge in a very vague way. They'll talk about growth at reasonable price or some other kind of secret sauce in terms of how they invest without being very clear about what their skill or their advantage is. And I think if you want to move away from thinking about performance and historic outcomes, you need to say, I'm looking at this active manager because I believe that they have this skill and I can evidence this in their historic behaviour, and that's what I'm investing in and what I want to see going forward. And that focuses you on the process side of things rather than just saying, well, the outcomes are good, so they've got a good process, or the outcomes are bad, so the process is bad. As we know, and as I wrote about recently, that even good managers with skill will go through periods of very difficult performance. So if your time horizon as an active fund investor is 3 years, you'll end up sacking everyone, because at some point they'll go through a bad spell and you'll sack them. And it's just a disastrous approach to investment to sack managers after 3 years of underperformance and buy ones that perform well over 3 years.
Yeah, what do you think a reasonable performance period to judge managers by is? I mean, you referenced 3 years, and everybody loves to use 3 years, and 3 years is a terrible, terrible period to use because that's a lot of times when the mean reversion is about to happen. But what do you think as an investor looking at funds? I mean, what is, we know things like value can go through like a decade where they struggle. What do you think is a reasonable time period to use if you're going to evaluate performance?
I think as long as humanly possible. So as much as other people will allow you to take that time horizon, then that time, as much as you can extend it, it's in your advantage. So if it's 7 years, it's to your advantage, even better if it's 10 years. That doesn't mean you hold everyone for that period of time, because their process might break down, or you might say, I was wrong about them having skill because the evidence doesn't reflect that they have skill. But if you're confident that they have a skill that over the long run will deliver value, and you've no reason to doubt that, then extending your horizon as much as possible. It's just a massive edge. It's a really theoretically a simple edge that investors can have, like extending your time horizon longer than other people. It's really easy to do in theory, really hard to pull off in practice because of the incentives around the industry, which are very, very short term. So I often think that private investors who've got no external pressures have a massive advantage because their only pressure is themselves. So they can be a genuinely long-term investor and have the benefits of that without professional investors who've got the threat of getting sacked after 2 years if they don't change their investment approach. You
referenced a good investment process, and I know you've looked at a lot of them in your career, and I'm wondering what the common characteristics are that make up a good investment process.
Yeah, that's a good question. I mean, I think the most important part for me is having, at the start, a clear view on what the edge or advantage or skill in the approach is. So this is what a process is trying to achieve. Too often it's quite vague about what they're actually trying to achieve, so it's difficult to build a process around that. So what are we trying to get to with the investment process we're building? So that has to be the starting point. And I think that a good process depends on what you're trying to achieve, but a few things I've kind of monitored through time, and what you really want is a process that allows for good, consistent decision making. So I think probabilistic thinking is really important, rather than kind of binary yes or no thinking in terms of how investment decisions are made. And I think classifying your decisions in a probabilistic way is useful because it is a good expression of conviction. If I say I'm 70% sure of something, it's a good expression of conviction relative to 60% or 50-50 because I don't know. So it's helpful in getting a team to understand consistently what the confidence in people's views are. But also critically, I think it allows people to change their mind. Because if you take a binary approach where something is good or bad or buy or sell, it's very difficult to row back on that. But if you say, I'm 80% sure this will transpire and be a good idea, then you're telling people, well, actually, in most scenarios it will be a good idea, but I'm aware that in certain scenarios it won't be. So it makes it much easier to change your mind and adjust that when you have new information. Something's changed about this, so I'm now 70% sure rather than 80% sure. So it brings a clarity and a transparency to an investment process, which I think is really important. I think it's quite rarely done. I think people dislike talking in probabilities because they think it's spurious accuracy and they think it's applying numbers to things that are too uncertain. But realistically, we're doing that anyway. We might not talk in numbers, but we're still applying probabilities to things when we make those decisions. So that kind of discipline and rigor, I think, is good in a process. The other thing I think is really useful is just an increased use of base rates when making decisions. So when we think about decisions within an investment process, don't think about your specific, unique decision and the features of that, but think about historic examples of similar decisions and how they've come to pass and and the odds around those decisions. So an example in fund selection, which you come across all the time, is that people will take what you could call the inside view on the decision. So they'll talk about, we found this fantastic manager with a great pedigree and a wonderful team. So that's the inside view. And the outside view, where you'll bring in base rates, will be the fact that in this asset class, only 5% of managers historically have outperformed. So that outside view context for the decision you're making is incredibly important to avoid this overconfidence and this focus on the specifics of the decision that you're making. So that type of inside-outside view and the use of base rates in decision making, which you see more of nowadays, but probably not as regularly as would be ideal, is quite interesting. And I suppose the final thing I would say is some type of post-decision review. So within the investment process, how are the people employing it trying to learn about the history of their decisions, about what they've got right, what they've got wrong, and how they might evolve it through time.
Yeah, you reference probabilities. That's probably one of the biggest things I've learned, in recent years. I read Andy Duke's book, Thinking in Bets, and this whole idea that if you think about all the decisions we make in investing, how many of them are really 100% certain decisions? Almost none of them. And so that's been a big thing for me, is just trying to put probabilities in advance on these things that I strongly believe, as opposed to just saying, this is going to be true.
Yeah, absolutely. And I think it's intuitively, it's quite difficult to do. It's quite hard to think through, but I think it's very rewarding once you start getting used to applying probabilities to things. That I think it does help decision making, but again, instinctively, it's not something we naturally do.
One of the things I've struggled with in my career is this whole idea, as I study emotions and biases more, I always think, well, I can just get rid of my emotions and biases. If I study it enough, it's just not going to be part of what I do anymore. And I've learned the hard way many times that that's not true. And I know your work is amazing on behavioral investment. And I wonder if you could talk about maybe some of the mistakes you've made in your career where behaviors come into it.
Yeah, list is long and distinguished. Yeah, so I suppose the most salient one that I think back to, although there's been plenty of them since, is I think it's probably late 2008, maybe early 2009, in the teeth of the global financial crisis. We sold out of high yield bonds. I think spreads on high yield bonds must have been, I don't know, somewhere between 1,000 and 2,000 over, and this was very much an inside view, outside view problem and failure. In that the inside view on this was the issue specific to our investment decision, which was the world is in a disastrous shape, the financial system is under huge strain, crunching recession, default rates in high yield bonds are going to be huge. Why do you want to hold them? So that was the specifics, and quite an emotional decision as well, because it was under such stress at the time. The outside view was the kind of the historic observation of when you buy high yield bonds at 1,000 over plus, you tend to make very good returns after that. And that was kind of just discarded because we were just being overwhelmed by the specifics of that decision. So we ended up selling them at a horrendous time, and often they went on to do fantastically well. But it's so hard to take a step back and think in a prudent and empirical fashion when you're in the midst of something that's so emotive and stressful, and when you have, I suppose, situations of stress or panic, your time horizon contracts really quickly from 10 years to 10 minutes, and you're just worried about what's happening right then. So you make really bad decisions. So it's probably the most painful when I look back, in terms of, and that was definitely, that was all behavioural, that decision. It was all a behavioural mistake about not having the tools in place to make prudent behavioural decisions at a time of stress.
Well, Joe, I'm just glad you didn't. I'm just glad you didn't say coming on our podcast was the biggest behavioral mistake. That would hurt.
Well, it's not over yet, so we could still get there. It's interesting too. I learned that same lesson because I don't know if you know the guys at Verdad Advisors, Dan Rasmussen. But they've sort of looked at the same thing. And, when high yield spreads are at their widest, that's maybe the best time to buy value stocks. And you'd think the opposite. You'd think these companies that typically have a lot of debt, you want to be nowhere near them. But, in reality, that ends up being a great long-term opportunity for value stocks as well, even though it doesn't feel that way.
No, and oftentimes the best behavioural thing to do is the thing that feels bad and feels wrong to do. And that might be buying stuff that's fallen quite a lot. It might just be doing nothing. So at times, most of the time, like the default option should be to do nothing and sit on your hands. But the temptation always behaviourally is to act and to do things, and probably at great cost. So we often do things that in the short term feel good, over the long term look very bad in terms of the investment outcomes.
I'm a little biased because I'm a quantitative investor, but one of your favorite articles you wrote was this idea of building a systematic replication portfolio for discretionary investors, so that they should, build this systematic portfolio as sort of a comparison for what they're doing on the discretionary side. And I'm wondering if you could talk a little bit about what the benefits of that are. Yeah,
so my thinking is any traditional qualitative active manager should build a systematic replica of what they do. So in essence, you say to the fund manager, if you were to run a systematic version of this, how would you do it? And that can be as simple or as complex as you like. It can be a set of decision rules in a fairly simple algorithm around portfolio construction, the type of stocks you might buy and sell, or you could even go down machine learning and try and replicate the behaviour of the manager in history. It doesn't really matter. I suppose it depends on the resources that you have and what exactly you want to achieve. But the reason I think for doing this and why it would be so valuable is that it enables the manager to see in a relatively noiseless fashion what decisions would be made based on their investment principles and process. So you don't have any of the noise or the stresses we talked about or the distractions that a human has. You've just got the pure systematic version of the strategy. And so you can observe it through time and see where are the distinctions between the decisions that we're making, where human judgment is coming to pass, and what's the systematic version doing through time. And that should be, for a manager, incredibly valuable as an idea generation tool, if nothing else, but also just to see. And fund managers really struggle to talk about this. So if you're going to buy an active fund manager, they need to be better than passive, and they need to be better than a systematic version of something doing something similar to what they're doing. Otherwise, there's no point. So they must believe there's some edge or advantage to human judgment. But often they're not very good at telling you what that is, and I'm not sure they really know what it is. So if you have a systematic version and you have your own version with human judgment, then you should be able to quite clearly see, well, we've got an edge because of human judgment, and this is it, because this is what we've done differently that would never have been picked up in the systematic version of what we do. So it allows you as an investor to focus on the things that you think adds value and not worry about the things that a systematic thing could do quite easily. And then when clients are saying, why are we paying you higher fees? You can say, because human judgment adds this type of value. Whereas a pure systematic, which might be lower cost, but we don't think it can do this type of thing. So I think it'd be very useful in that regard. And one of the comments I got on the post was from an economist who said that they ran systematic forecasting models, which they found were very useful most of the time, but at inflection points, when things move very quickly, they broke down and weren't very useful. And that's exactly what you want to see in terms of, actually, most of the time these work, but we think that at times in inflection points, then human judgment or human overlay is required to refine the models or make them better. So you can say to clients, this is exactly the value we're adding with human judgment. But I found generally, whenever I've spoken about this, fund managers are incredibly reticent to do it, incredibly reticent to even think about it, because they say, my strategy can't be replicated systematically. You just can't do it. And it's just like magic, because they can't tell you why, but it's just like, well, good things will be done to you and you won't really know how it's done, but trust us, they're being done. So which is just, in this day and age, when active management is under such pressure, I don't think it's not really good enough, and I think they need to justify it and justify what it is, what the edge is that people are paying for.
I would think one of the big fears would be, what if the systematic portfolio beats me? What do I do then?
And that's absolutely right. I mean, I think you have this problem, I think, certainly with large asset managers, where if you created a systematic version of a portfolio to help you make decisions, which is a good thing, other departments would get hold of it and then probably sack you if it performed better than you. So you're right, that people will be very worried about it outperforming them. But yeah, that's not a great reason not to do it, but people haven't been very receptive to doing it.
I want to shift gears and talk about, you wrote an article about 10 common mistakes that fund investors make, and you had some great examples in there, and we can't go through all of them, but I wanted to go through some of the points you made there and maybe see if you could expound on them a little bit. And the first was searching for performance consistency. I find this so frustrating in that people, I know this is widespread, that when people are looking at active funds or anything that's not a pure passive, they rate things based on performance consistency, so how consistently they've outperformed, generally over a really short period, so quarters or years, as if that is in of itself an indication of skill. But to believe that, you have to believe that either someone can predict markets over the short term. If they couldn't, they wouldn't outperform consistently, and nobody can do that, so that doesn't work. Or you believe they've got a style that outperforms in every environment, and there's no such thing as that. So the logical extension of that is it's just randomness. And if fund managers, let's say fund manager were just picking names of stocks out of a hat, you'd still get consistent performance just through randomness, and it would look like skill, but it would just be pure luck. So performance consistency is used frequently as shorthand for skill, and it's just nonsense. It's just randomness or style biases that work for a period. There's no reason to believe that any fund manager will consistently perform, just because markets are random and capricious and no one can predict what they'll do from one quarter to the next, so why should you expect there to be consistent performance? And I think it's a time horizon problem again, is because people have got a 3-month view and they should have a decade's view, and that's a massive problem. Yeah, calendar years can be an issue with this as well. I don't know if you remember, when Bill Miller had his 17-year streak where he beat the S&P every year. If you had looked at different trailing 12-month periods, it didn't end at the end of December. He actually didn't beat it for 17 straight years. It was just the fact that investors were focused on calendar years.
Absolutely, yeah. I mean, the time horizon that you use and how you cut it can have a huge impact. But if you get enough people flipping coins, someone's going to get 10 heads in a row, and then someone will think they're particularly skillful, and it's just kind of luck and randomness. And we like to build narratives around that and around that randomness.
The second point you made in the article that I wanted to ask you about is neglecting the circle of competence.
Yeah, this is a big problem as well, where it's certainly been an issue in the UK in fund management in the last couple of years, quite significantly so. But when we have successful fund managers, they tend to be regarded as great investors in very broad terms, as if that means something. But obviously, investing is a huge array of different types of games that people play and partake in, very narrow things as well. But when someone's a star fund manager in particular, we just assume that they are great investors, and then they go and start doing other stuff. So we've had investors in the UK going to invest in China, or investing in unquoted biotech stocks, just doing things where they've got no pedigree, no evidence that they've got skill in that area, but because they're great investors, then we're happy for them to do it. And you get people kind of moving out of their circle of competence just through chance, really. So you have a manager who's investing in smaller companies, becomes very successful, but the asset size grows so much that they have to invest in bigger companies, but they've got no skill doing that. So you can get forced out of your circle of competence quite easily. And it goes back to my point that you need to have a view. If you're investing in any type of active strategy, whether it's quant or smart beta or traditional qualitative active, then you need to think about what is the skill here. And it should be very focused and narrow about this is the skill. And then if they start doing stuff outside of that, then that invalidates your idea of what the skill is. So you shouldn't be using them anymore. So you need a clear idea of what the circle of competence is. And also the other part is you should know what your own circle of competence is, and probably know that it's narrower than you think it is as well.
The third one I want to ask you about is a pet peeve of mine as well, because you'll have investors a lot of times say, I'm invested in XYZ index, so I'm not an active investor. But the reality behind the scenes may be a little different than that. So can you talk about your point of forgetting we are all active investors?
Yeah, I mean, there's this spurious notion that someone can just be a passive investor, as if there's this kind of passive neutral portfolio that isn't taking a view. I think it's obviously passive has done better than active in broad terms. If we talk about fund and indices in the last decade, but it's taken hold really because a combination of being long US equities and long global ag, like the classic 60-40 split has done so well, and that's felt to be like the neutral portfolio. But your choice of indices and how you allocate your portfolio is always an active view. So whether you choose to be equally weighted or market cap, whether you choose to include emerging markets, whether you include smaller companies, do you do S&P 500 or do you do a total market index? You're always taking views. There's loads of active views even in what might be a passive portfolio. So lots of investors that have been passive are now very long duration and very long US equities. And 10 years later, if that hasn't worked, is that fine because that's just a passive investment, or has that underperformed other passive stuff and passive stuff that has worked better? So I think you need to be very clear about I might be investing in passive underlying, but I'm still taking active views on market cap and countries and on credit quality. And you need to be very clear about what those bets on views are.
And the last one I wanted to ask you about is ignoring the odds of the game.
Yeah. So I think again, this goes back to base rates, and that we always need to think about, for any decision we have, what are the odds of success? And that's not easy, and there's no magic number that you can pull out for a decision, but you need to have an idea of what the game is you're playing and what the chances of success are. So, but the obvious one is looking at success of active managers in various regions, in various markets, various types of styles, and thinking about historically how well that's worked. And different markets will have different success rates. Some will be 10%, some will be 50%. And there'll be a lot of reasons for that. But you need to understand, before you make a decision, what you think the odds are, what you think the chances are of success. Because it doesn't matter. I'd rather invest in a kind of slightly above average active manager if the odds of success were 50% than in a great active manager if the odds of success were 1 in 100. So you need to think about what the chances are of success, rather than just simply kind of the specifics of the investment that you're making.
One of the, I guess, ideas that we hear a lot about in the market is the current value of stocks today represents the intrinsic value that all investors are giving the stock in the market. And you kind of flip this a little bit with your article, Why Should Equities Be Fairly Valued? And you sort of made the point that, investors are actually measuring many, many different things. Intrinsic value might be whatever, 1% of how investors are choosing to buy and sell sort of stock. So I was just wondering if you could kind of explain that argument a little bit more.
Yeah, absolutely. So I find it puzzling that everyone spends a lot of their time talking about the intrinsic or fair value of equity markets, which is an interesting but unknowable thing. I find it puzzling that people spend so much time thinking about it, and also the idea that the market is efficiently priced because lots of people are trying to find intrinsic value, which to me is nonsense, because as you say, I don't think many people are trying to do that. If you think about the wisdom of crowds model, which I think is why people think that equities might be efficiently priced based on that, so you have lots of different people guessing the weight of an ox, and all of that information comes together and aggregates into something that's quite close to the actual answer. But that's not analogous to this situation, because no one is trying to find intrinsic value, or virtually no one's trying to find intrinsic value. So it's like trying to guess the weight of an ox by taking the average of someone guessing the weight of a pig, of a cow, of a sheep, of doing all sorts of different things and then saying, well, that's a good guess for the weight of an ox. And it's not. You've got so many investors with a variety of time horizons. There might be price momentum investors, there might be macro investors, the vast majority of whom could not care less what the intrinsic value of equity markets are. So I suppose the point I was making is that on any given day there is no reason to expect equities to be a good approximation of fair value. That doesn't mean I don't think valuation doesn't matter, because I think it really does matter, and what you pay for something is, aside from behaviour, is probably the largest determinant of the long run returns you make. It's not going to matter, and it's not going to matter on any given day. So I kind of class it as, I think there's a weak gravitational pull from the fair value of equities. So equity markets will kind of wax and wane in a fairly random fashion, probably an upwards trajectory through time, and they'll randomly pass through what fair value might be at various points. And there's a weak gravitational pull, because if it gets too extreme, then investor behaviour will change quite significantly. So if equities are incredibly cheap, they'll get pulled back down by investor behaviour change, and if they're incredibly expensive, I think investor behaviour will change as well. So I think extremes are quite important, and it'll move back around and through fair value at various points in time. But again, there's no reason to believe that equities are the best guess of fair value today or will be tomorrow. And I can't understand why people would think they would be, given most people aren't even attempting to find out what that is.
Speaking of value, and I think this quote kind of captures it, which is the quote that the market is a voting machine in the short run and a weighing machine in the long run. That's a basically Buffett quote. It's a modified Ben Graham quote, because he actually didn't say that. He said something different. But I'm just wondering, what are your sort of current thoughts on sort of where we are, not today in the market, but what we're seeing sort of over time, and whether or not the market may be more of a voting machine in the long term as we become a little bit less tethered to fundamentals? I mean, do you think that idea has any merit, or is it just the environment we're in today? Maybe that.
Yeah, I think it probably does. So I think fundamentals and cash flows and the reinvestment of those cash flows will matter a great deal over the long run. But I think what we've got is a combination of, as we've talked about already, lots of people with shorter time horizons and different investment approaches, doing different things and investing, playing different games in the stock market or in the credit market. So the fundamentals for different types of investors are just different. So I guess the fundamental for a momentum investor or a day trader is very different to what it is as we might classify long run fundamentals of equity investing, for example. So I think there are more people doing very different things in markets, which probably makes markets noisier and probably harder to deal with in terms of their daily and weekly and monthly fluctuations. So I think you get more noise over the short term, but over the long run, those fundamentals will still matter. But probably sticking with a process that is reliant on the fundamentals might be harder in the short term than it was previously.
We've talked a lot about time horizon and how that might be, an edge for some investors, particularly individual investors that aren't under pressure. So, but you wrote a good article, The Three Elements of an Investment Time Horizon, where you looked at time horizon through objectives, interactions, and then activity. And you kind of segmented these things out and how each one of those was important when thinking about an investor's time horizon. So I was just wondering if you could kind of explain that.
Yeah, sure. I mean, how we manage our time horizon is just so important behaviourally from an investment standpoint. I think objective is something where it's obviously, I think it's often quite misleading because we might have an objective written down on a page. So a fund manager might have a 5-year objective, or a private investor might have 30 years to go until they retire and start drawing on their pension. So you might think that's the time horizon, but that's probably not the time horizon. That's probably some other objective. So if you think of the fund manager example, you might have a fund manager that's going through a difficult spell of performance, and their clients are requesting frequent meetings. They're worried about losing their job. So their time horizon might be 3 months or 6 months. So they're not making decisions based on a 5-year horizon. They're making decisions about what they think might work in the very short term because they're managing career risk. Or you might have a fund manager with a performance fee structure, and their behaviour is changing because that's crystallising in a year's time. So they might have a 5-year horizon as their investment objective, but they're getting paid over the next year. So they make decisions based on that. And even with private investors with long horizons, if they're buying the latest flavour of the month ETF, for example, they're not thinking about long run horizons. They're thinking about the returns they're going to make over the next 3 or 6 months. So I think we need to be clear about what a genuine objective is when we're making an investment decision from a time horizon perspective. The second point was on interactions. And the frequency of interactions with our investment is really important, because our behaviour, as I've said earlier, is a reaction to stimulus and how often we interact with markets. So every time we check our portfolio value, or we read a news article, or we read a blog post, we are interacting with our investments, where there is stimulus there that might make us act and make decisions. So we're much more likely to be a long-term investor if we don't check our investments or read financial news every day than we are if we're poring over it every morning and afternoon. So limiting our interactions is quite a useful behavioural tool into making us long-term investors. And the final part is activity, and that's just the ability to trade. So we have our interactions with it, which kind of gives us a stimulus and makes us want to trade, and then you have to have the ability to trade. So if you're locked into an investment for 5 years, that means you can't trade, so you can't make as many behavioural mistakes. That's not. So I'm not suggesting you should get locked into investments, but one benefit is your inability to trade. And I think that's probably the real illiquidity premium, is you can make fewer behavioural mistakes because you can't trade. So if there is any advantage to that type of liquid investing, it's probably behavioural rather than anything else. So I think from a time horizon perspective, you need to think about what your real objective is, and then try and focus your interactions and your activity in a way that can align you with that time horizon. If you've got a 20-year time horizon and you're checking your portfolio every day, the frequency with which you check your portfolio will win that battle.
One of the things I think as investors, we have a tendency to sort of anchor on our past experiences and kind of fight the last war. So for example, after the 2008 financial crisis, everyone was kind of looking for the next big downturn, which, didn't really come. But when the next big downturn sort of did come, and even though it was short, it was due to a pandemic that no one saw coming. So I think you've written about this idea of, not letting our past experience sort of drive maybe the investment decisions going forward. And I'm just wondering how you think about risk in the context of the full spectrum of possibilities that can happen in the market, and maybe not being too anchored to those past experiences.
Yeah, I think you're absolutely right. I think we spend kind of a decade after a major risk event in markets thinking about that risk event and trying to prepare for it happening again, and of course it never happens again, and it's an entirely different risk that comes to pass. And I've kind of spent a lot of time looking at macro hedge fund style strategies, and in the decks they'll always have details on risk reports they've got, stress tests, looking at how the fund would have performed in previous historic risk situations, which is pretty meaningless for a variety of reasons, but particularly because the next major risk will not be captured in their model. So I'm sure they'll be adding kind of global pandemic to the risk model, and we'll worry about that happening again over the next 10 years, and it will be something different that transpires that we won't predict. So it's really hard, actually, because I think what we need to think about is that we're dealing really with uncertainty rather than risks. Risk is where we think about outcomes that are known, and they've got different probabilities assigned to those, and uncertainty is where we've got a huge range of different probabilities and possibilities, and we don't know the full scope of what they are. So we're in an uncertain environment. And we're really bad at dealing with those risks and uncertainties. So we tend to just think about the things that are salient and available. So we won't insure our house against flood risk until it's been flooded, and then we'll be very keen to insure it. So it's when those risks or uncertainties become salient in our minds that we tend to deal with them. So I think the most important thing is to not spend a lot of time trying to predict specifically what the next risk event will be, because we will be wrong. So we need to think about there are a broad range of outcomes, and some more negative than we might expect. Don't spend too much time forecasting exactly when the next recession will be, or what will cause it, but maybe just think more generally about, if we've got a portfolio, we can think about there'll be scenarios when equity markets could well be down 40%, for example, over a time horizon. We don't need to know what causes that, and in fact we'll never know what causes that, but let's think about risk in terms of the periods of volatility and the periods of loss we'll go through in our portfolios for unidentified reasons, and then think about how we'll deal with that type of situation. So I think the problem we'll have is thinking too much about stories and making forecasts about the future that we can't do, but rather than saying there's a variety of different paths that our portfolio could take for reasons that we don't know, are we prepared for this broad range of different paths? So thinking about your portfolio and saying, something happens and there's a recession or there is a shock and it's down 30%, how would you deal with that? Are you comfortable with that type of situation? Is much better than saying, I think that there's going to be a recession next year because of X, Y, Z happening, because I just don't think, obviously we know that people are rubbish at making those types of forecasts, and we shouldn't spend our time doing it. We should spend our time being behaviourally prepared for the consequences of very negative risks, rather than predicting exactly when they'll occur or exactly what will cause them.
Jack, I guess this means our global pandemic risk parity strategy has to be sunsetted.
I was just getting that thing running.
We're just not. No, but that's great, Joe. Thank you. So for our last standard closing question, we like to ask all of our guests, and you've been great with your time today, so we really appreciate it. Based on your experiences in the market, if you could impart one piece of wisdom or teach one lesson to your average investor, what would it be?
Yeah, so this is going to come as no surprise if you've listened to the full conversation, and that's I just try and check your portfolio less frequently. This is really hard for professional investors to do for obvious reasons. Provide private investors, it is certainly possible. So I think if you want to control your behaviour, one of the crucial ways of doing it is to interact with your portfolio less frequently. So make sensible long-term investment decisions and stick with them. It's a key motto, I think, for most investors. Doesn't mean you never touch them, but if you're prudent and moderate in how you interact with your investments, then you're far more likely to make good decisions and fewer decisions through time. If you interact with it too frequently, you're increasing the risk of making behavioural mistakes, which will just compound significantly and negatively through time. So check your portfolio less frequently after making sensible decisions at the start.
Thank you, Joe. If people want to learn more about you, read your articles, get on your email list, where can they go?
So it's on behaviouralinvestment.com, and I'm also on Twitter at behavioraljoe.
Great. We'll put links to those in the show notes, and we just want to say thanks for joining us. We hope you have a great summer. Good luck in the new position. We wish you all the best, and looking forward to continued articles from you. So thank you.
Really enjoyed it. Thanks very much for your questions. Take care, both.
Thank you.
Thank you.
Cheers. Bye-bye.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.